Hey everyone, and thanks for jumping back into the cryptoverse. This is a premium video, and in this video, we're going to be focusing on time spent between the risk bands, but we're going to focus on the trends from one market cycle to another. So thanks for tuning in. I hope this is informative. And then we're also going to briefly touch on logarithmic regression, give an update to what's going on there. And then also, I'm going to help you visualize the moves in each market cycle by playing 3 videos for you that show, how the risk levels accumulate days associated with those risk levels as we move forward in time. So you basically get to experience each market cycle in 20, 30 seconds or so. And then finally, we'll pull up the chart, the Bitcoin chart. So let's go ahead and jump in. So the first thing is we're going to look to see how long we spend in each risk band if we measure our market cycles this way. So the first way we're going to do it is we're going to measure from bottom to top for market cycle 1. Market cycle 2 is this bottom to this top. And then market cycle 3 would be the bottom we had in 2018 at the end of 2018, assuming that that was our bottom, and then it just takes place to present day. So note that the third market cycle is not complete. We're also going to look at bottom to bottom as well after we go through this one. So the first thing you notice is that there tends to be a trend in the middle risk bands. So if you look between 0.2 to 0.8, each market cycle, for the most part, and I think it actually is true for most of these market cycles, but you can see, from the 0.2 to 0.3, the first market cycle was shorter than the second. 0.3 to 0.4, the first market cycle was shorter than the second. 0.4 to 0.5, the same thing. 0.5 to 0.6, same thing. 0.6 to 0.7, and then 0.7 to 0.8, same thing. So between the risk levels of 0.2 to 0.8, we spent longer in each risk band during the second market cycle, which is between these red lines, than we did in the first. Which makes sense. I mean, if the cycle is longer, we're going to have, more days in total, right, to, spin within each risk band. But it's interesting because, the general trend holds that as we traverse each risk band, between 0.2 to 0.8, we're spending more time in each band from one market cycle to the other. On the other hand, if you look at the extremes, so 0 to 0.2, we're actually spending less time. Okay, so think about that for a minute. So the amount of time that you have to buy Bitcoin between the 0 to 0.2 risk band is decreasing from market cycle 1 to market cycle 2 in this one, and then market cycle 1 to market cycle 2 in this risk band as well. So I think this is somewhat of the market maturing. Savvier investors are recognizing where the bottom likely is. It tends to be around the 200-week moving average if your time frame is weekly, and therefore we just don't spend a whole lot of time in this risk region. So this trend could stay like it is, and we don't actually have to go back to this risk level. There's no, in terms of looking at the macro trend, seeing the number of days decrease in this risk band, we don't actually have to go back. Of course, I could have visualized this as, say, like percentage of time in each risk band, and maybe I can do that next week. But the focus this week is just to look at days in the risk band, because now we're going through the third market cycle, and we want an idea of how many days are we going to be in each risk band. So between 0 and 0.2, we don't have to go back to that level. Obviously, it's possible we do. I mean, we could always push this number up by a couple months and still, stay within this trend, but it's certainly not necessary. Between 0.8 and 0.9, you can see 0.8 to 1, there's really not a huge trend at all. In fact, between 0.8 and 0.9, it decreased from the first market cycle to the second, but then the second one, it increased. But you also have to remember that this is looking just from the bottom to the top. It doesn't include what happens just after the day of the top. So that could influence things, because if after the peak, if you say spend another several days in this top risk band, it's not getting captured by this first method because we're just measuring it from bottom to top. So if you dive into this further, you can see, between the 0.2 to 0.3, maybe we would expect to spend more time in this risk region. We're still a couple months behind the last two market cycles in terms of days spent in this risk region. Now, that does not mean that we have to drop back to those price levels at current day. We know that the risk levels are dynamic, so it could be that we drop back to this risk region, but it could be a year from now, for all we know. It doesn't have to be tomorrow, but I always say you need to always be prepared for a drop back to this region. If you're curious, this region 0.2 to 0.3 is around a price of Bitcoin, I think roughly corresponding to like $5,000 to $7,000. And note that the 200-week moving average is $6,000. So a retracement back to the 200-week moving average would start increasing this band as well. So this is a possibility. Just keep it in mind. If we do retrace to the 200-week, it could happen a year from now. And lengthening cycle theory is still intact because our next projected peak is likely 2023, plus or minus 6 or 8 months or so. So it's not obvious if we'll come back to this one. It seems like we'll likely re-enter this risk band at some point during the market cycle. Whether it happens in the short term or not is up for debate. But this is why, and yet another reason why having capital on the sidelines is usually smart, because if we were to drop back to this level, you're going to want to take advantage of it. Certainly, we have plenty of time left in this market cycle to spend between 0.3 and 0.4. We know from a past newsletter that this is the band we spend the most time in, and you can even see it on this chart. We're spending a lot of time within this risk band. So I would anticipate us spending, you can see so far this market cycle, we've spent just over 150 days in this risk band, and during the last market cycle, we spent almost 300 days. So we probably have another half year within this risk band. And again, the prices corresponding to those risk levels are dynamic. So it could be that in 2 years, we're still, our risk is 0.35, but maybe the price at that time is $11,000. So you take this into consideration, but I do anticipate us, spending a long time in this risk band, as well as the 0.4 to 0.5 risk band, which we haven't spent a ton of time in yet this market cycle. We spent about 150 days in this risk band, but again, we're probably going to spend, another 4 or 5 months at least within that risk band before going up to these higher numbers. So I'll let you guys read the newsletter to get more of the takeaways from that chart. We also, if we go down to the next page, the second way we're going to define it is by measuring from market cycle bottom to bottom and then bottom to bottom. So you can see that even in this view, our cycles are getting longer and longer, going from here to here and then here to here. And even if you were to take this as the bottom, maybe going from here to here would be your first market cycle. And then this would be second, third, and fourth. But I'm ignoring this data just because it's really not sufficient to show where the true bottom is, because Bitcoin was released on January 3rd, 2009. And this is just where I have reliable price data. So I shouldn't make a ton of conclusions based on that. Now, if you were to look to see, so bottom to bottom, this is more of a continuous thing that goes through the peak and then goes to the retracement down to the bottom. So in this situation, you can see it's a similar story. Between 0 and 0.2, it's diminishing with each market cycle. Between 0.2 and 0.8, it's going up. From the first market cycle to the second market cycle, the time is going up. And the reason the third one hasn't gone above these yet is just because we're still in the very early stages of the third market cycle. We still have years to go. We're talking about if there's a peak in 2023, maybe a bear market in 2024. Our next bottom could be in 2024, 2025. So we have a long time to fill out this graph. But I would anticipate us spending a lot more time, between 0.2 and 0.8 during the extent of the current market cycle. So just take this into consideration, and I'll let you guys read the newsletter if you want more information on that. I thought it'd be good to give a brief. Before I jump into the newsletter, let me show you guys one other thing, because it's with regards to the risk bands. So let's go ahead and pull up these videos. So if you notice, you can see we have 3 videos here. So market cycle 1, market cycle 2, and market cycle 3. And then I've just put in the price on here so you can kind of follow along. So what it's going to do is it's going to walk through the market cycle at 10 days per second. Okay, so 10 days per second. It's going to fill out the number of days in each wristband, so then you can like live it in a sense. You can live what was going on during that time, how many times we went to one wristband and came back. So you can watch that. So let me go ahead and start it. So this is the first market cycle. You can see, about a month or so in the first band, a couple months so far in the second band. And in fact, in the first market cycle, we did spend a decent amount of time in the 0.1 to 0.2 risk band. You can already see that it's, so far we just started in this first band for a month, then went to this band for about 4 months or so, then came down to 0.2 to 0.3, then 0.3 to 0.4. So we're slowly moving up. I know this is a little boring to just watch, but I think it's important to just kind of live it out. So you can see we went to the 0.3 to 0.4 band, came back to 0.2, came back to 0.3, came back to 0.2. They're kind of dancing back and forth right now. So you can see how volatile the price is. And this is why I say, it doesn't go up monotonically. And then you can see we quickly go up to the peak, but it's this first peak. And then we retrace. And then when we retrace, we come back down to the 0.4 risk band right now, and even to the 0.3. So you can see this would have given you time to reaccumulate, in the hopes of, say, this another shorter term bubble. And this is what happened. We spent another few months in that risk range, and then we ultimately came back up. So you can see during the first market cycle, a ton of time was spent between 0.1 to 0.4. And then as we went out further from here, we spent less and less time. And this is why I say it's always important to have a plan, because when you get into these risk regions, we're only going to spend a few weeks there. So it's why I feel like it takes years of preparation in some sense, emotionally, so that you know that when the time comes, it's really not going to last forever. Now I'm going to play the second video. So this is the second market cycle. It's going to take a good bit longer. You can see less time was spent in the first risk band. Then we spent a while in the second risk band, but not quite as long as the first. And I think this is, again, the market maturing, realizing that we're not going to stay at these, low risk regions for very long. One thing that's interesting too is that, it's always the case, I think, that the 0.2 to 0.3 band we have spent less time there than the 0.1 to 0.2 in the first two market cycles. And here you're really going to see the 0.3 and 0.4 bands dance between each other. So, price will go down, it'll stay in that band for a few months, and then it'll switch back to the 0.4 band, and then that band will go up for a few months, and then it'll just basically dance back and forth during the second market cycle. So I think it's interesting because it just goes to show you that if you were taking profits at, say, the 0.4 risk band, and then buying back in whenever it dropped to the 0.3 risk band, you would have had several opportunities to take advantage of this during the second market cycle, disregarding obviously the short-term tax implications or short-term capital gains tax. But you can see, again, we spent a long time. I mean, so far in the 0.3 band, it looks like it's already at around 300 days. This band, another, 250, 260 days. And then we came up to the higher risk band. Now it's dancing between, say, 0.5 and 0.6, flirted with 0.7, back to 0.6, back to 0.5. It's going to be a grind. It's going to take a long time, but then at the very end, it just quickly goes up to that final band, and then that's the peak. Okay, so this is how quickly it happens. Now, for completeness, we're just going to put on the third market cycle just so you can see what it's done so far. We spent like 1 day in that first risk band that you can't even really see on the screen because of the resolution. But as we go up, you can see we're spending a lot of time, relatively speaking, in the 0.3 to 0.4 risk band compared to the other ones. You'll see this in a minute once it starts to really go up. But this is corresponding to 2019, this shorter term speculative bubble that occurred. And then ultimately we did retrace back down to the levels we're at today. And then we've spent a decent amount of time at our favorite risk band that Bitcoin loves to be in, 0.3 to 0.4. And then, followed fairly closely, I think, by 0.4 to 0.5 in terms of, time spent in each risk band. So this is the phase where we're dancing. We're just dancing between these accumulation region risk bands. And this is why I say, dynamically DCAing can be useful, because we're going to jump between risk bands. Like it's a fact that we're going to jump between risk bands. And if you can have the patience to put more money in when the risk drops, then ultimately you're going to hopefully have more later on to sell. So don't discount the chance that we go into another short-term speculative bubble this year. But at the same time, we may come back down to the lower band here. And if you're not sure, the lower band at current levels is around $5,000 or so. So I think a move to 5,000, 5,500, 6,000, back to the 0.2 to 0.3 band, always on the cards. If that happens, just be ready for it. It's nothing you need to be fearful of. We're still looking out to the longer term picture, right? Of looking at, say, a 6-figure Bitcoin, maybe 3 years from now or so. So it doesn't really affect that. I've included the regression the regression curve in the newsletter, so you can just peruse it at your liking. And then also we have the percent difference between the primary regression band and the price. And remember, our current level, while we've been going up for several months, we're only around 10 to 20% overvalued compared to our fair value price. For reference, the overvaluation in 2017 was around 1,000%, and currently we're between 10 to 20%. So I think that if you draw the imaginary line here and extend it out to 2023, it puts us at around a 3 to 400 peak, 3 to 400% overvaluation peak, which at the time Bitcoin's fair value will likely be between $30,000 to $50,000. So if it's overvalued by 3 to 400%, then it's likely going to get us to somewhere around $100,000 to $150,000 at the next paradigm shift peak. And then finally in the newsletter we have the risk levels that we generally include, which you can see here. It looks like this one got messed up, but I'll fix that in time for when you guys actually view the newsletter. But I hope this is informative. These risk charts that I just add in at the end, so you guys can see if there's a certain coin you're really wanting to follow. And then note, we also have the S&P 500, which personally I've been buying it since March. I did make a video on it back when the risk was around 0.29. And I'm still buying, believe it or not. I've just been slowly buying, dynamically DCAing. I put a lot in down here, putting less in up here. But we'll see what happens. I mean, obviously a lot of people think we're going to drop. I don't necessarily think that has to be the case, because I don't think many people anticipated this move to begin with. So just some things to take into consideration. Remember, if you want to follow along with the primary regression chart, just go to intothecryptocharts.com and you can see it. It's updated live. You can see our current price and then the non-bubble price, which means this is where we would be if basically on this fitted line here. So make sure to check that out. Finally, I just want to pull up the chart of Bitcoin. We've said before that historically speaking, statistically speaking, Monday at around UTC, later in the morning or in the early afternoon, tends to be, statistically speaking, the best time to buy Bitcoin. And for the most part, since we published that video 5 weeks ago or so, we've pretty much always seen a retracement leading up to that. And despite the fact that we've always seen a retracement, over the last couple months, the price hasn't really moved that much. So ultimately, it lets you continue to get into Bitcoin at a lower price than if you were saying, purchasing it on say every Thursday or every Friday. Now, I haven't done the numbers yet. I don't know if it's, if purchasing on Monday at a certain time has been uniformly better than every other day of the week. But maybe in a future report, we'll say, okay, we said that Monday was the best day. Now let's go back and look, how has it performed with what our expectations were? Has it continued to perform like that? Was it informative to use that as, say, or was it useful to use that to inform our future decisions or not? And I think so far, as many of you have experienced, the answer is yes. So far, continuing to purchase Bitcoin on Mondays if you're going for the the DCA approach weekly, then purchasing on Mondays has been fairly good so far. We typically see a retracement Sunday evening, and this is Sunday evening my time. So take this into consideration. If you're purchasing Bitcoin, go back and read that newsletter if you haven't yet, so that you can get up to date with why I'm saying this, like why I say Monday is the best. For those that are not aware, for Ethereum, the best day historically speaking is actually Friday. So Monday for Bitcoin, Friday for Ethereum. So I hope this has been useful to you guys. A lot of the reason for this video, for the wristband, traversing the wristbands, it was a request to basically say, okay, well, can we visualize how much time in each market cycle we're spending within each wristband, so that I can get an idea of, say, the likelihood that if I sell my Bitcoin at a certain wristband, what's the chances that it goes back to a prior wristband in the short term. And just remember, you can always go back and watch these videos. We have these 3 videos, so feel free to just go back in this video and watch them. And if there's enough interest, I can always upload them to Google Drive so that you guys can just watch them and fast forward through them at your leisure. So I hope this has been informative. Going forward, Bitcoin, it certainly is seeing a pullback now, just in time for the weekly buy if you follow that. But again, we're still fairly above the 20-week moving average, so that is currently at around 8,300. If you see us drop below this price, so if Bitcoin drops another, say, 10% or so, and you see us dropping below the 20-week, this is when personally I would be consolidating and getting rid of a lot of my other positions and a lot of other coins, and consolidating to Bitcoin and or stable coins. I hope that if we do continue to drop, I'm hoping that the 50-week at 8,600, 8,700 will help provide some level of support. If not, the 20-week is probably on the cards next. So I think that'll go ahead and wrap it up for the video. I hope you guys enjoyed it. Let me know what you guys think, and I will see you guys next time. Bye.